Hello and welcome to your Monday Futures Market Outlook for September 17th, 2012. This is Patrick Ceresna. For those of you that have not had the opportunity to try out the eveningsource.com trading room, complimentary memberships are available on the website. As always, we start off with a chart of the U.S. dollar index futures, and we've had a material and substantial deterioration of the U.S. dollar that has put an end to the uptrend that we've seen over the past year. This certainly is quite substantially oversold and has approached a level where support has been found in the past around this 79 and a quarter area. And we will be watching today whether the U.S. dollar can hold and find these support levels. Even a temporary break below there doesn't mean that some sort of a bounce would not be imminent. This is obviously being fueled by substantial concerns about the degree of intervention that the Federal Reserve is putting into the markets. But nonetheless, a U.S. dollar here that weakens on the downwards will likely bounce. Well, it's when the bounce finally does occur, and let's say get a bounce back to 80 or 81 on the upside. If we see no stability or follow through, that could lead to another wave of selling at some future points. We're not trying to be overly bullish, but it is likely here that there's a very good chance of a bounce. Next year, when we take a look at the euro, we can see where much of that strength has actually come in. The euro had that bullish breakout on this that substantially strengthened it up towards the 132 level. This is a very pronounced and very steep rally. These types of rallies, again, are very uncommon to this degree, and really the squeeze higher can still last longer. We could temporarily see a euro that tries to test 133 or 134 on the upside toward the highs of the year, irrespective of whether it makes it that high or not. The reality is that the risk-reward proposition of chasing the euro here is substantially diminishing, as where you're risking substantial amounts to try to get to ride the momentum. Really, at this stage into strength, we would be sellers of the euro. Next year, I want to take a look at the 30-year Treasury bond, and we've seen some selling follow through from the FOMC statements, which suggested that there's much more intervention going to be in the mortgage-backed security market over that of Treasury bonds. Nonetheless, the inflationary pressures of the market have materially demonstrated themselves on the 30-year Treasury bond, which has to price in a substantial amount of inflation into the future. With commodity prices having such substantial rallies, this is certainly going to make a material impact. We're at a support line where there's room for a bounce, but what we will be looking for is that if the Treasury bonds fail to have any rallies of significance, will a bigger picture sell-off ensue for the remainder of the year in this Treasury bond market. Next year, we're going to take a look at copper, and copper really has done very well ever since the inflationary pressure started coming in with the QE, and really at this stage, this rally as well is a little bit steep in its breakout, and we'll be looking for consolidation points. But so long as all pullbacks are held and contained to the support lines around that 355 area, then it is very likely that copper still can strengthen further throughout the remainder of the year. Next year, I want to take a look at crude oil, and crude has strengthened and broken out to new highs, which is optimistic. Really, at this stage, there is room for crude oil to push even up to this 104, 105 level up above. We'll be seeing whether or not they can hold this rally. The only thing that would be concerning here is if this breakout attempt resulted in a drop back down to $97 or $96, which would mean that the breakout on the upside was not validated. Really, at this stage, the bulls here need to just maintain these prices at these higher levels and follow through on some further strength, and we have maybe potentially even another $5 upside potential. Next year, I want to take a look at gold futures, and gold continues to head right up towards the February and March highs around that 1800 level. This is going to be the first place of good overhead resistance. While we're recognizing a big change in trend in gold, we also believe that the risk-reward proposition on the short term is poor, and that at some point consolidations that could be as much as $50 to $100 on the downside could happen before the next really good buying opportunity of gold. So we're really looking at the idea buy on dips at this point, as chasing gold higher here has a diminishing risk-reward proposition. Finally, that brings us to looking at the S&P 500, and here we can see that August consolidation, when that flag broke on the upside, created that substantial follow-through and bullishness up towards now the 1475 level, plus minus 5 points. This is an area where we expect there to be overhead resistance, while there is definitely a measured move that can target as high as 1500, and we certainly wouldn't want to stand in the way of this marketplace here. Recognize that markets very rarely will go straight up without having a number of corrections to buy on dip. At this stage, similar to our outlook on gold, we see very little value in chasing this market, and would look at corrections of 20 to 30 S&P points as levels where we see whether or not there's room for this to continue still in a few higher steps. Just to make some key intermarket observations, we have seen material moves in the U.S. dollar and U.S. bonds, which have created a mixed long-term picture on many of them. U.S. bonds still are relatively in an uptrend, even though we've seen a pullback. But in both cases, the risk-reward proposition of buying them here on the short term for a bounce is good. Any market bounce though that you do get has to be reevaluated as if it is a change in a primary long-term trend to, let's say, a bearish U.S. dollar or a bearish bond market. That would substantially change the landscape going forward. So recognize, even though I'm putting short-term risk-reward is good, that's only for exactly what it means, a short-term bounce. Commodities are a mixed bag at this point. The trends have been higher. We are looking for pullbacks in order for the risk-reward proposition to become good and being buyers of commodities. Similarly, in U.S. and global stocks, while we're recognizing that trends have been up, overall, we need pullbacks in the market to buy on dips. At this point, chasing the market higher has a poor risk-reward proposition. That was your Monday Futures Market Outlook. Thank you for joining me.